Great, thank you. We're going to go over the backdoor Roth versus the mega backdoor Roth. We're also going to answer some of your questions today. Let me share my screen here. So the mega backdoor Roth is oftentimes meant to describe the mega backdoor Roth 401k. In this case here, the mega backdoor Roth solo 401k. Backdoor Roth means that you are making a non-deductible IRA contribution, and then you are converting that non-deductible IRA contribution to a Roth IRA. So that's the terminology that's used for the mega backdoor Roth versus the backdoor Roth. Let's talk about the differences between the two. Let's first talk about the backdoor Roth. So it's generally used by individuals who make over a certain limit of their adjusted gross income. Because once you make over a certain limit, the IRS rules do not allow you to make Roth IRA contributions. Hence why it's called a backdoor Roth, because you go ahead and make a non-deductible IRA contribution regardless of your adjusted gross income. So you typically make that non-deductible IRA contribution to your existing traditional IRA, or you can open up a separate IRA to make that non-deductible IRA contribution. Once you make that non-deductible IRA contribution, you then immediately convert those funds to the Roth IRA. Now, it's important to note that the backdoor Roth, when compared to the mega backdoor Roth, is subject to the pro rata rule. The pro rata rule calculates the taxable portion of the conversion based on the ratio of after-tax contributions to the total balance across all traditional IRAs, including SIP IRAs and simple IRAs. In short, if you're trying to do a backdoor Roth IRA conversion, you have to look at all your IRAs before you can process that conversion, because you can't just cherry pick and say, I'm only going to convert the funds in my IRA that only holds non-deductible IRA funds. You instead have to convert some of the basis and some of the gains. Now, that pro rata rule does not apply to the mega backdoor. That's one of the big differences between the backdoor Roth and the mega backdoor Roth, aka mega backdoor Roth solo 401k, or mega backdoor Roth 401k if we're talking about a full-time employer 401k. And the reason that pro rata rule does not apply to the mega backdoor Roth is because the funds are held in a separate holding account under that 401k, a solo 401k in the case of a self-employed individual, where you have separate holding accounts for each source of funds. So therefore, that pro rata rule does not apply, since they're going to be held in a dedicated account titled voluntary after-tax contributions. So the voluntary after-tax contributions flow into that bucket, aka bank account, brokerage account, under that 401k or solo 401k for a self-employed individual, and from there they get converted to the Roth solo 401k or the Roth IRA. So that's one interesting item to understand regarding the pro rata rule, how it applies to the backdoor Roth, but not the mega backdoor Roth. Now let's start talking about the mega backdoor Roth. With the mega backdoor Roth, in the context of a 401k, we're going to hone in on a solo 401k here. You make the voluntary after-tax contribution to the solo 401k bank account or brokerage account that's specific for holding those voluntary after-tax contributions. You then convert those funds in that voluntary after-tax bucket to the Roth 401k or Roth solo 401k, or you can convert it to a Roth IRA. So that entire bucket, that entire voluntary after-tax bucket has to get converted. Now, another big difference between the mega backdoor Roth and the backdoor Roth is that you can make higher contribution amounts using the mega backdoor Roth. So it's more lucrative. So for instance, if you're doing a backdoor Roth IRA conversion, the maximum you can contribute to that backdoor Roth IRA is $7,000 for 2024, where you make an annual contribution of $70,000 to the non-deductible IRA and then immediately convert it to the Roth IRA. If we're talking about the mega backdoor Roth, and if we're talking about a solo 401k here, you can make a total of $70,000 for 2025 as an annual contribution to the voluntary after-tax bucket of the solo 401k. So that's much higher. And then you can convert that $70,000 immediately to the Roth solo 401k bucket or to a Roth IRA. Now, it's important to note that in order to utilize the mega backdoor Roth strategy, you must have a plan that allows for the mega backdoor Roth. So unlike an IRA where a plan document does not apply, and thus the backdoor Roth can be accomplished through a non-deductible IRA, in order to perform the mega backdoor Roth, you have to use a solo 401k provider, such as my solo 401k financial, whose plan document allows for the mega backdoor Roth, that is. Now, most full-time employer plans don't allow for the mega backdoor Roth because the IRS non-discrimination rules apply. That rule prohibits after-tax contributions for higher paid employees unless lower paid employees make a certain level of contributions. So for instance, if you work for Microsoft, the Microsoft plan probably does not allow for the mega backdoor Roth because of the non-discrimination rules. However, I do know that the Amazon 401k allows for the mega backdoor Roth. So it just depends on that full-time employer. So again, a solo 401k is not subject to the IRS non-discrimination rules. Thus making it a popular plan for performing the mega backdoor Roth. For instance, let's say you work for Walmart and you contribute to their 401k, and then you're self-employed on the side, so you open a solo 401k. You're going to be able to utilize the mega backdoor Roth for that self-employed solo 401k plan, as long as you open that plan with a self-directed solo 401k provider whose plan allows for the mega backdoor Roth. More on that example. Let's say that your self-employed business, it's an S corporation, and that you make at least $70,000 of W-2 wages for tax year 2025. Furthermore, let's assume that you maximize your contributions to that Walmart 401k. You're still going to be able to do the full mega backdoor Roth through that solo 401k plan, using my example of being self-employed in an S corporation, and you pay yourself $70,000 in W-2 wages. You'll be able to contribute that entire $70,000 to the voluntary after-tax bucket under the solo 401k, and then immediately convert it to the Roth solo 401k bucket or even to a Roth IRA. So that's an example of being able to contribute not only to your full-time employer 401k up to the maximum of $70,000 for 2025, but also doing the mega backdoor Roth using a solo 401k, being able to also do another $70,000 of voluntary after-tax contributions as part of the mega backdoor Roth, and then converting it over to the Roth solo 401k. So in review, in order to do the mega backdoor Roth, the plan must allow for in-service distributions of after-tax contributions. And of course, you also need to be able to afford to contribute the after-tax contributions. So using my example of an S corporation, if you pay yourself only $30,000 in W-2 wages, you're only going to be able to contribute $30,000 as a voluntary after-tax contribution to the solo 401k, and then convert it over to the Roth solo 401k or the Roth IRA as part of the mega backdoor Roth. So it takes money in order to contribute. It takes earned income in order to contribute. You can't contribute based on funds in your personal bank account or gains in your personal brokerage account. It's got to be based on your earned income from your self-employed business. That's going back to my S corporation example. If you don't report at least $70,000 of W-2 wages, you're not going to be able to maximize the full $70,000. Okay, why is it best to convert right away, whether we're talking about the mega backdoor Roth or the backdoor Roth? It's best to convert those funds right away once those contributions are made, because typically the earnings are going to be taxable when you convert those over to the Roth. So for example, let's say you make an annual contribution for 2025 to your IRA as a non-deductible IRA contribution because your earned income is too high, your adjusted gross income, so you can't contribute directly to a Roth IRA. Let's further assume that after you make that contribution of $7,000, you wait to convert a few days or a month, and now the value of that IRA is $7,500. Well, you would convert that entire $7,500, and you may have to convert even other funds if you have other IRAs, as we talked earlier, but let's not complicate the example. So you would convert that entire $7,500 from a non-deductible IRA to a Roth IRA. Therefore, you're going to have to pay taxes on $500, not the $7,000, because after-tax contributions, whether non-deductible IRA contributions or voluntary after-tax 401k contributions, are always made with after-tax money, so they're not tax deductible on your tax return. But the gains are taxable. Same example using the mega backdoor Roth. Let's say you open a solo 401k plan in 2025. You make the overall contribution limit of $70,000 to the voluntary after-tax solo 401k bank or brokerage account. Let's say you wait a few days or a week to convert, and now that contribution of $70,000 has increased to $72,000. Therefore, you have $2,000 in gains. You have to convert all the funds in the voluntary after-tax solo 401k bucket. So if you convert the entire $72,000 to the Roth solo 401k or the Roth IRA, you're going to have to pay taxes on $2,000. So $70,000 will get converted. That's not going to be taxable because you can't take a deduction when you make a contribution as a voluntary after-tax to the plan. But the earnings are taxable when they get converted to the Roth solo 401k or the Roth IRA. So that's why it's best to convert right away so that there are no gains. And you don't have to wait a certain amount of days before you convert. You just have to make sure those funds are cleared and ready to be converted. Now, both a Form 1099-R and a Form 8606 apply to the backdoor Roth IRA conversion. So the backdoor Roth is subject to both Form 1099-R reporting and Form 8606 reporting, whereas the mega backdoor Roth is only subject to Form 1099-R reporting, not Form 8606 reporting. A Form 1099-R is used to report the conversion from after-tax funds to the Roth. So if you're talking about a non-deductible IRA, which is part of the mega backdoor Roth, and you make a contribution of $7,000 for 2025, for example, you then convert that over to the Roth IRA, you're going to receive a Form 1099-R by early next year from the IRA custodian, because they have to report that conversion, and it's not going to be taxable if there are no gains. So it's reportable, but generally not taxable if there are no gains. Same thing with the mega backdoor Roth for a solo 401k. For example, let's say for 2025, you make the voluntary after-tax solo 401k contribution of $70,000. You then convert it here in 2025 to the Roth solo 401k or the Roth IRA. You're going to receive a Form 1099-R early next year for reporting that mega backdoor Roth conversion to the government. And if there are any gains, those gains will be taxable, but not the basis. So those are the key items to understand regarding the backdoor Roth versus the mega backdoor Roth. Let's take a look at some questions here. Okay, so we've got a question here. Does my solo 401k allow for employee after-tax deductible contributions? So after-tax employee contributions are never deductible. You might be referring to the employer Roth contributions as part of Secure 2.0 Act, where you're allowed to make employer Roth 401k contributions. And our plan does allow for employer Roth 401k contributions, which are deductible on the business side, but then they're going to be considered taxable on the personal side. Okay, great. It looks like that's the last question we have today. Again, thank you for joining today's daily webinar. We'll be on again today at 1 p.m. Pacific time. Until then, have a great day.